I was a good participant. That was the problem. There's a feeling I want to describe before I explain anything. It's not a crisis. It's quieter than that. It's the feeling of looking at your bank statement at the end of a month where you earned well, where the bonus came in, where you didn't do anything obviously wrong, and noticing that the number at the bottom is roughly where it always is. Not catastrophic, just stuck. I had that feeling for 20 years. I had it with an overdraft in the UK that never quite cleared, not because I was reckless, but because I was careful. I had it with a credit card in New Zealand that I could never quite clear, despite earning more than I ever had. I had it every April when the bonus arrived, and I used it to reset the balance to zero, only to watch it creep back over the following months. I wasn't going backwards, but I wasn't getting ahead either. If you've felt this, and I suspect many of you reading this have, I want to tell you something important. It wasn't your fault, and it wasn't an accident. The rules I followed. I grew up believing certain things about money. Work hard, get promoted, buy a house as early as you can, it's the best investment you'll make. The mortgage is good debt. Pay off the bad debt, the credit card, and remortgage to consolidate what's left. Save when you can. Invest through a managed fund and let the professionals handle it. These weren't fringe ideas, they were the mainstream. The banks repeated them. The financial advisors repeated them. The TV repeated them. My parents' generation had followed these rules and it had broadly worked for them, so I followed them too. My wife and I bought our first house in 1991. I was 21. We paid roughly 3 times our joint income in a market that had just come out of the ERM crisis, so we actually caught a rare moment of relative affordability. We moved up the ladder as the family grew. 3 daughters, bigger houses, bigger mortgages, better salaries. Career progression at a global legal data and analytics company where I eventually became managing director of the New Zealand operation. By every conventional measure, I was winning. And yet the overdraft persisted. The credit card balance persisted. The bonuses reset the clock, and then the clock ran forward again. I reread that paragraph now, and I can see exactly what was happening. At the time, I had no framework for it. I assumed it was a personal discipline problem, that I just needed to be a bit more careful, a bit more intentional. I never once questioned the system I was participating in. I was a good participant. I just didn't understand what the game actually was. The invisible force. In 2009, we were living in Auckland. I was earning well, and I remember seeing houses in Albany, then still a relatively quiet suburb on the North Shore, selling for around $150,000. I didn't buy one. I had equity. I had income. The numbers would have worked. But everything I'd been told said, pay down your existing mortgage, don't overextend, be sensible. The house we lived in was the investment. The Albany house was a risk. Today, those same houses sell for over $1.1 million. That single decision, or rather that single non-decision, cost my family somewhere in the order of $1 million in real wealth. Not because I was foolish, because I was following the rules I'd been given, in a game I didn't fully understand. I'm not telling you this to invoke sympathy. I'm telling you this because I know you have your own version of this story. A property you didn't buy. A stock position you didn't hold. A decision you made inside a framework that turned out to have a significant flaw at its center. The flaw wasn't your risk tolerance. It wasn't your timing. It was that nobody explained to you the single most important force acting on everything you owned, everything you earned, and everything you saved. The podcast that changed everything. In 2023, I was between roles. I'd come back from working in the US after my employer asked me to relocate, a moment that effectively ended 35 years of corporate life. I was doing contract work, some trading, neither was going particularly well. I had time, for the first time in decades, to actually look. I started trading seriously and discovered something quickly. The retail investor is structurally late to everything. Late to the bull run, late to the reversal. The smart money, the institutions, the funds, the desks with real data had already moved by the time the signal reached me. I was losing money, and it wasn't because I was making bad decisions. I was making decisions with the wrong information at the wrong time, in a system designed to extract value from exactly my position. Then I heard Raoul Pal on the Diary of a CEO. The podcast was primarily about cryptocurrency, but in the lead-up, he said something that stopped me completely. He talked about house prices. In the 1980s, he said, the average house cost roughly 3 times the average salary. Today, it's 8 or 9 times in the UK and the US. Across New Zealand, it's around 10 to 11 times, and in Auckland specifically, it's closer to 18. I stopped what I was doing. 3 times salary, that's what my wife and I paid in 1991. 3 times our joint income, and I was 21 years old. That number was available to us. It was tight, but it was reachable. My eldest daughter is 31. She's renting in London with her partner. My middle daughter and her husband have a strong combined income by any measure, and they're still years away from being able to buy in Auckland. My youngest is 26, engaged, and has been living with us to save. They are not doing anything wrong. They are not spending irresponsibly. They are running at full speed toward a finish line that is moving away from them faster than they can run. And in that moment, hearing Raoul explain this, I understood for the first time why. The word I'd never heard. The word was debasement. Not inflation in the CPI sense, the 2-3% your supermarket receipts are supposed to reflect. Something deeper. The systematic expansion of the money supply itself. To put it plainly, central banks create money. When they create it faster than the economy produces real goods and services, each unit of currency quietly buys a little less than it did before. Not dramatically, silently. A few percent per year. Compounding over decades without ever appearing on a statement. Since 1971, when the US abandoned the gold standard and every major currency became effectively a political decision rather than a fixed quantity, this has been happening continuously. New Zealand's broad money supply has grown at approximately 5 to 7% annually over the past decade, per the Reserve Bank of New Zealand's own published data. Australia's broad money grew at 7.8% in 2022 alone. The US Federal Reserve expanded its money supply by 26.9% in the 12 months to February 2021, the largest single-year expansion in recorded American history, confirmed by the Federal Reserve Bank of St. Louis's own research. Economists use the term M2 to measure this. It's simply the total amount of money in the economy, including notes, coins, and bank deposits. When M2 grows faster than the real economy, purchasing power erodes. Not in the prices you see on a shelf. Those move slowly and are carefully measured. In the real value of everything you've saved, everything you've earned, and everything you're owed. More money chasing the same goods, the same houses, the same assets. That is why the overdraft never cleared on the same income that should have cleared it. Every pay rise was partly illusory, denominated in a currency that was worth marginally less than the year before. Every bonus that reset the credit card was buying slightly less reset than the previous year's bonus. The treadmill wasn't running faster. The floor was moving. And the Albany house? It didn't become worth 10 times more because Albany got 10 times better. It became worth 10 times more because the currency it's priced in became significantly less valuable, and land, being finite and real, absorbed that debasement. Once I saw this, I couldn't unsee it. 4 people I want you to meet. I want to introduce you to 4 people. You may recognize some of them. You may be one of them. Jamie is 28. She rents in Auckland, earns $72,000 and has 18,000 euros in Kiwi Saver she can't access. She saves around $400 a month, which feels like progress until she looks at what a house deposit requires. She follows finance content online and has a growing sense that something structural is wrong, but nobody around her can explain it clearly, so she's left with vague anxiety and conflicting advice. She used to want to own a home. Lately, she's not sure she even wants to anymore, not because she's given up, but because the goal itself has started to feel cruel. Every dollar saved toward a deposit is a dollar not spent on the experiences that make life feel like it's being lived. The dream hasn't just become unaffordable, it's started to feel like a trap. What debasement is doing to Jamie? Her Kiwi Saver grows nominally, while the asset she actually wants, a home, inflates faster than she can save. Her $400 monthly saving is denominated in a currency expanding at 5-7% annually. She's running up the down escalator and the speed keeps increasing. What Jamie needs, not more savings discipline, a framework that explains the mechanism so she can make decisions inside it rather than around it. Mark is 38. He owns a home in Brisbane, earns $130,000 and has $85,000 in superannuation. He has a self-managed portfolio of about $45,000 across ASX and US stocks. He trades occasionally when something catches his eye. He's had some wins and some losses and attributes both roughly to timing. His portfolio is up 12% this year and he feels reasonably satisfied. What debasement is doing to Mark? Australia's broad money grew meaningfully through the past decade. A 12% nominal gain in a year of 6 to 7% monetary expansion is a real gain of perhaps 5 to 6%. Some of what Mark calls profit is simply his portfolio keeping pace with currency expansion, not creating real new value. He doesn't know this because his broker statement shows 12% and doesn't show what the currency did. What Mark needs? A way to contextualize his returns against the actual monetary environment, and an intelligence layer that tells him what's happening beneath the prices he can see. Sarah is 45. She lives in Wellington, earns $180,000 and has $220,000 in KiwiSaver and $150,000 in direct investments. She knows what dark pools are. She reads macro commentary. She's built her own system, spreadsheets, multiple platforms, a news aggregator, charts she checks manually. She understands more than most, and she's exhausted by the overhead of maintaining it. What debasement is doing to Sarah? She has the intellectual framework, but not the unified infrastructure to act on it systematically. Her portfolio has no real-time monitoring against the macro backdrop she understands. She sees the mechanism clearly and still can't act on it efficiently. What Sarah needs? Consolidation. One platform that watches everything she's watching so she can make decisions rather than manage process. David is 58. He lives in Christchurch. He has 2 properties worth a combined $1.8 million $380,000 in KiwiSaver and $420,000 in a growth-managed fund. His annual fund statement shows 10% returns. He feels good about this. His advisor told him he has a growth risk profile and his money is invested accordingly. He doesn't think about it much. He has what looks like significant wealth and a comfortable life. What debasement is doing to David? His $420,000 in the fund returned approximately 10% last year, $42,000 nominally. After the management fee of 1.05%, he netted roughly $37,590. After NZ broad money expansion of approximately 5.6%, his real purchasing power gain was approximately $16,000 on a $420,000 investment, not 10%, closer to 3.8%. The $26,000 gap didn't disappear. It was redistributed. Some to the fund manager, some to anyone holding assets that absorbed the debasement, gold, property, hard assets, while David held a fund denominated in a currency that expanded while he slept. David also doesn't know that in the most recent year, his actively managed fund returned 11.37% after fees, while its own benchmark index returned 11.90%. The fund he's paying professionals to manage didn't beat the passive index it tracks. This is disclosed in the fund's own quarterly filing. Nobody sent him that paragraph. What David needs: to understand that comfortable is not the same as safe, and that the institutions managing his money are not optimized for his purchasing power, they're optimized for their benchmark. Some Davids, upon learning this, take matters into their own hands. They open a Sharesies or Hatch account and do what almost every personal finance Reddit thread recommends: buy an S&P 500 index tracker. Lower fees, broad exposure, 15% average annual returns. It feels like a responsible, sophisticated decision. But here's what those threads don't explain. The S&P 500 is a market cap weighted index, meaning the largest companies by value have the largest influence on the return. In recent years, a handful of mega-cap technology companies have represented 30 to 35% of the entire index. The 500 companies of diversification is partly an illusion. And the 15% nominal return, stripped of monetary expansion and expressed in real purchasing power terms, is a meaningfully smaller number than it appears on the screen. This is not an argument against index investing as a starting point. It is the same argument this entire piece has been making. Nominal returns, presented without purchasing power context, are not the complete picture. The Reddit consensus, like the buy a house, get a mortgage advice before it, is the crowd repeating what worked in yesterday's conditions without asking whether those conditions still hold today. What David and every Shares user sitting on an index fund actually needs is intelligence. Not just a position, the ability to understand how each asset is performing against their actual strategy, what the signals say about what's happening beneath the price, and what the real terms return looks like once the monetary environment is accounted for. Once you have that intelligence layer, the index as a destination rather than a starting point starts to look very different. What sovereignty actually means. I want to be precise about this word because it gets misused. Financial sovereignty doesn't mean going off-grid. It doesn't mean distrusting everything. It doesn't mean predicting crashes or betting on collapse. It means understanding the mechanism and making decisions inside it rather than around it. A sovereign investor asks different questions than a delegating investor. They don't ask, what did my fund return this year? They ask, what did my fund return relative to monetary expansion after all fees? They don't ask, is my portfolio diversified? They ask, what percentage of my portfolio is in assets that historically preserve purchasing power when money supply expands? They don't ask, is my advisor qualified? They ask, is my advisor's objective the same as mine? And if not, what is it? These are not radical questions. They are the questions that investors at professional institutions ask as a matter of routine. What hasn't been available, until recently, is an accessible way to ask them systematically, with real data connected to your actual positions. What I built and why and who it's for. After the Raoul Pal moment, I went looking. I found the Everything Code framework, Raoul Pal's thesis that the global debt cycle is the master variable that explains almost everything: asset prices, monetary policy, housing affordability, geopolitics. I found Ray Dalio's work on long-term debt cycles. I taught myself how AI works and how to leverage it. I learned to code, building tools initially just for myself, ways to see the signals that institutional desks see connected to the positions I actually held. I talked about this with a friend one evening. He listened for a while and then said, "You should sell this." I hadn't thought of it as a product. It was a personal response to a problem I'd finally understood. But he was right, because the problem I was solving for myself is the same problem Jamie, Mark, Sarah, and David are living with, at different levels of awareness, with different tools and different urgency. I want to be honest about who Stack Motive is built for right now and who it will grow to serve. If you're Jamie, just beginning to understand the mechanism, not yet in a position to actively manage investments, the sovereign signal is where you start. The newsletter exists to give you the framework before you need the tools. You don't need both on day one. Understanding the problem is the first act of sovereignty. If you're Mark or Sarah, actively managing positions, frustrated by fragmentation or flying blind on what's really happening in the market, Stack Motive was built for you. It connects your actual holdings to institutional-grade signal intelligence, dark pool monitoring, confluence alerts, AI-generated daily briefings tied to your specific positions, and the macro context that puts your returns in real terms. If you're David, comfortable, delegating, beginning to ask harder questions, start with the questions above. Take them to your next advisor meeting. The answers will tell you whether you need to change anything. The information asymmetry between institutional investors and retail investors has always existed. What's changed is that it no longer has to. The letter I wish I'd received. I want to end with something personal. When I was in the UK in the late 1990s, looking at a bank statement with a persistent balance I couldn't understand, I was a good participant. I believed the TV. I believed that politicians were trying to help people like me. I believed the mortgage was good debt and the overdraft was my problem to solve. I wish someone had sat down with me then and said, "The reason you can't get ahead isn't discipline. It's that the currency you're earning and saving is losing purchasing power faster than your raises are replacing it. The overdraft isn't a failure. It's the mathematical outcome of the system you're inside. Here's the mechanism. Here's what you can do about it." Nobody said that. My 3 daughters are living inside the same system at a later and more acute stage of the same cycle. My eldest is renting in London, trying day by day to make choices that make her feel free rather than trapped. My middle daughter and her husband are earning well and still can't buy in Auckland. My youngest is saving while living with us because there's no other way to make the numbers work. They are not failing. The mechanism is working exactly as designed. The sovereign signal exists because I believe the most useful thing I can do with what I've learned is to give other people the chance to see it sooner than I did. Whether you're ready to act today or just beginning to understand, you're in the right place. Stack motive exists because understanding the mechanism is only useful if you have the tools to act on it when you're ready. And this letter exists because somewhere, right now, someone is looking at a bank statement that should show more progress than it does, and they deserve an explanation at the very least. Stack motive is available now. The Observer tier is free. Start there.